Good morning. We are here we have our director, Mr. Kavita Rao, is sharing Professor Fiscal Management, and we will share what's happening in the Indian economy. And I'm going to present something and from Krishna from Ashoka University is will be discussing this discussion. So
I generally believe I'm pretty loud, but I've been told it's good to use the mic, so stick with that. Welcome. We at the Institute have been trying to figure out new ways of organizing ourselves a little bit. Changes, we have new people coming in, so it's always a good time to reimagine and reconstruct what we would like to see going forward. And while there is a lot of I think there's a cacophony of opinions on what's going to happen in the economy because there's a lot of people tracking what's happening. I think we feel there is merit in trying to spell our thought pre-budget to get a sense of how the economy is going. And then revisit what we believe happened during the budget so that since we are primarily a public finance institute, for us it's important to know what's happening in the economy and also to have a sense of public finances. So this is our first read, perhaps what used to happen a long time ago. And we'd like for it to be an interactive, interesting discussion, but first to all the researchers who contributed to put it all together. So I'll hand it over to you all, and let's hope. I'm hoping to get a lot out of it, but I don't know what the rest of it. So we'll see.
Professor Mangal, for view at the beginning of the discussion.
Yeah, thank you. So let me join Professor Rao in welcoming all of you. I think we're having this kind of in-person meeting after a long time because of the COVID period that we've been through. So it's very nice to have you here with us there with session. And I'd also like to welcome those who are joining us remotely for making the time to participate in these discussions. So to start with the conversation, let me start by saying that, as everybody knows, we are really in a very challenging economic situation. Globally, things are really very bad. We are there with a stagflationary situation, low growth, even negative growth in a number of countries, and very high inflation. This has all come with the oil shock, which has been followed by, as you know, the Ukraine war and the sanctions and so on. And on top of that, now you have very strong hawkish stance from the US Fed and others to try and kill the high inflation that you're seeing there. It has been said that India is in a relatively sweet spot compared to that, but we also have very serious domestic challenges. Inflation has been elevated. It has been generally above the tolerance band of the RBI, the headline inflation. Will just come down a little bit in November. And of course, growth has been slowing. We had very high growth last year, something like quarter of this year, mainly because of the strong base effect of the earlier contractions. But now, as that the base effect is fading, we see that growth is rapidly coming down, and so that has become a new challenge. And thirdly, of late, we are also seeing a sharp increase in current account deficit. Generally, as a rule of thumb, we believe that something like 2% is a kind of safe level, but now we are hitting 10%, so bills are beginning to go off. So the question is, in this very challenging context, what are the appropriate monetary or fiscal policy challenges? How do you navigate this very difficult time? And this is complicated by the fact that, at least as for the fiscal outlook, many of the drivers of inflation actually are supply side disruptions, whereas all the instruments at the command of the central bank to control inflation are really demand management tools. So that makes it even more complicated. But I'm not going to take more time in these introductory remarks. So we will flesh out this whole situation that I've just been briefly describing, and then look at possible for the fiscal policy, appropriate policy stance, both on the fiscal and monetary side. So Professor Rani Bhattacharya is going to walk us through the situation on the real sector, growth, inflation, and the balance of payments challenges I just mentioned. After that, Dr. Radhika Pandey is going to deal with monetary policy and financial markets. Professor Manish Gupta will then talk to us about the fiscal outlook, and not just at the union level, which is what is usually done pre-budget, but also what's going on in the states, because as we will see, there are some major issues at the state level. And then I'll come in at the end briefly just to put it all together and highlight the main takeaways. So let me stop there and done.
Low base effect. Indian economy recorded a high 8.7% growth rate in the last financial year 2021-22. That after a contraction of 6.6% in the COVID year of 2021. So this 8.7% sharp jump was actually on account of the low base effect of the previous year. Actually, it was around 1.5% higher than the just 1.5% higher output growth compared to the pre-pandemic level. That was so. The most of this sharp increase is because of the base effect. So we see that we project that in the next financial year, so the current financial year, depending on what financial year 22-23, we're going to have a growth slowdown of 6.9%. And this growth slowdown is basically on account of base normalization, because this year we are not going to have that low base effect of the pandemic year. So base normalization and the fiscal consolidation that is being will depend on what kind or fiscal compression that is being seen in many of the states in India. So these two factors will lead to a growth slowdown in the current financial year. And we also project that our growth for the next financial year 23-24 will be 5.2%, so further slowdown. But this actual outcome of the next financial year will depend on what kind of policies are taken by the government and how the economy responds to it. So if you look at the table, our projection for quarterly growth rates are also showing that for the next for the last half of this financial year, the 2 quarters, we are going to have growth slowdown compared to the previous growth rates that are recorded in the Q1 and Q2. So Q1 was recorded a very high growth rate of 13.5%, 5%, and that was again because driven by the low growth effect, because the quarter one, that is April to June quarter of 2021, was severely affected by the second wave of the pandemic, leading to lockdown and output loss and everything. So there is a contraction. So that has driven up the quarter one growth rate in this financial year. And so in quarter two, the Indian economy has recorded a growth rate of 6.3%. So as we have seen in the table, this graph is actually comparing the Q2 output of pre-pandemic level, which is the black bar, then pandemic year, which is the red. This in quarter two, the growth slowdown is on account of the contraction in mining and manufacturing. So mining and manufacturing output has contracted. However, we see a high growth, 14.7% growth in the hotel trade and trade, transport, and hotel business services. So this graph is actually comparing the Q2 output of pre-pandemic level, which is the black bar, then pandemic year, which is the red bar, and then last year, that's 21-22, that's the green bar, and the blue one is the Q2 of 22-23. So if we compare this over these years, the quarter two output over these years for different sectors. So before first time, this TRD, which is the trade, hotel, and transport services, so that has come up to the pre-pandemic level. Before that, it was always below the pre-pandemic level. So whatever the high growth we have seen in the services was actually driven by base effects. This is the first time we see that it has recovered. The services has recovered. But for all others, so before they have recovered earlier, even earlier. But if we look at the manufacturing sector, it's in this year Q2, it has contracted to the pandemic level. But and this is also to note that the pre-pandemic output was even lower. Pre-pandemic manufacturing output was even lower than the pandemic output. So what actually going on? What's going to this subsectoral level? So before going to subsectoral level, I'll go through the what we see in the demand side. So we see that government expenditure, final consumption expenditure, that has not recovered to the pre-pandemic level yet. It's still below that. Whereas private consumption expenditure, investment demand, export, import all have recovered and they are growing. Whereas expected on which consumption expenditure is still below the pre-pandemic level. So now going to the what we see for the different subsectors and what are so these up to this we have the scenario that we see for the quarter two of this financial year. But what ahead we can what outlook we have ahead of this quarter. Expected on which quarters what we expect from at the sectoral level. So on agriculture. It's expected that it's a normal rainfall year. Then there is domestic wheat price is on rise, which has led to the sown area under Rabi crops to increase this year compared to the last year. So there is a bumper crop is being expected on wheat, and that is being also reflected in the resilient tractor sales growth, domestic sales of growth in domestic sales of tractors. So we expect a robust agricultural growth for this coming quarters. On industry, it's we see alarming sign there is a broad-based contraction in all across all the activity-based and use-based categories of IIP. So if you we have seen that in Q2 we have seen contraction in mining and manufacturing. Now, if you look at this, the third panel below that. Primary, capital, intermediate, and now see that construction is also going down. So we can expect a construction sector contraction in the coming quarters. Now, why we see this? So during the pandemic period, it is our engine of recovery was manufacturing, because manufacturing recorded a very high growth here. But if we look at it was actually driven by the here. But if we look at the last year, and the passenger car sales and commercial sale of commercial vehicles growth have bottomed down. So it's just it's flattened. It's not moving. So we are going to the engine, the force that was there through the automobile demand, that is not things across the countries of themselves. So there was a high demand for automobiles, so passenger cars, three-wheelers, and the other type of cars. So that led to a high growth in the manufacturing, and that also was reflected in the consumer durables, because that time that period is not shown here. But if we look at the last year, and the passenger car sales and commercial sale of commercial vehicles growth have bottomed down. So it's just it's flattened. It's not moving. So we are going to the engine, the force that was there through the automobile demand, that has receded from the economy. Native domain, and the passenger car sales and commercial sale of commercial vehicles growth have bottomed down. So it's just it's flattened. It's not moving. So we are going to the engine, the force that was there through the automobile demand, that has receded from the economy. Again, on the services, again we see a broad base that's showing up. So all the indicators of services are showing a sort of a again a slowdown, indicating towards the slowdown. So what is the on the inflation front? So during the pandemic year, and which is true for the pre-pandemic period also, inflation was mainly driven by the food inflation. So food articles in through like sea, then air and railways all have gone down. We see that there is a overall declining trend in the telephone number of telephone subscribers, and the NSE turnover is showing a negative growth rate, because it's it's showing up the uncertainties that are there in the that's showing up so in the global economy, and that's showing up. So all the indicators of services are showing a sort of a again a slowdown, indicating towards a slowdown. So what is the on the inflation front? So during the pandemic year, and which is true for the pre-pandemic period also, inflation was mainly driven by the food inflation. So food articles inflation, which was co-moving, which gave a similar movement in the CPI food inflation, WPI food inflation, and overall CPI and WPI inflation. But a diverse pattern of the dynamics during the post-pandemic period, which is 21-22, when food inflation was moderated, food articles inflation moderated, so CPI inflation was moderated, But that time it was broad-based. It was due to high inflation in all the food, core, and energy inflation. Whereas in WPI inflation was also elevated, and the dynamics of CPI and WPI inflation. Uh, in the current period, we see that again there is a food inflation is kind of driving the pattern of inflation in all the categories. So in the 22-23, food inflation remained, the overall headline inflation remained elevated at, it was broad-based. It was due to high inflation in all the food, core, and energy inflation. Whereas in WPI inflation was also elevated, and it was also driven by food, core, and energy inflation. So, Ukraine war has this. So the factors that have driven during this period, the factors that has driven food inflation are mainly supply driven. So it's the weather condition is one. So we had very excess rainfall during the November to January, November last year to January this year, which has actually led to wastage of crops and led to Ukraine war has been driving up the food inflation. Then we had cost push inflation like every wage inflation, and there has been MSP hike introduced in the last budget where MSP on rice, wheat, and pulses were 2, 3, and 5 times than the previous year. So that has been driven up this food inflation. And we had the crude oil inflation, and Ukraine war has given this to again surge to crude oil inflation and edible oil inflation. Sorry. Core inflation during the pandemic year, it was the health and transport that was driving the core inflation, that kept the headline the CPI core inflation high. Now from 2022, we see a broad-based rise in core inflation. Global, all the components of the core inflation are showing up are on rise. So, and if you remember, we have seen that there we see a private demand, so consumption demand is reviving. So that's also corroborating this broad-based rise in core inflation. On energy, global crude oil inflation had a one-to-one transmission to WPI crude petroleum. That's the black broken line. But the transmission to WPI and CPI energy inflation were lagged. So even if now global inflation, global crude oil inflation are on downturn, but due to the lagged inflation, that energy inflation, domestic energy inflation, both wholesale and retail are still sticky, high and sticky. So these are keeping the energy inflation high in the country. Tolerance band. We forecast that in next 2 quarters we are going to have 5.5% inflation, and for the whole year it's going to be 6.3%. So that is higher than the Rbi'S tolerance band. So the yearly, over this financial year, we are going to have an inflation rate that's going to be higher than the tolerance band. Now, going to balance of payments, we see a rise in current account balance deficit, which is driven by trade deficit and mainly merchandise trade deficit, because we see that if we compare the orange part of the bars and the blue part of the bars, so blue are the merchandise trade, showing the merchandise trade deficit, and orange is the services. So imported input, that merchandise trade deficit, there is a deficit and it's increasing, whereas the on services we are having surplus. So we see that the deficit is rising and is till June it's increased to 2.8% of GDP. Imported input. We see that most of the items in the export basket have contracted, so that's reflecting our export slowdown. We see that there is a contraction in most of the intermediate goods import basket. That's reflecting that why our manufacturing has contracted, because if your imported inputs have contracted, then that's showing an impact on the manufacturing. And how 50% of the services net exports is again contracted. So is half showing there's a positive growth in the net export, half is in the in half showing there is a contraction. So net financial account flow, so we have surplus in the net financial flows. So this shows that this financial surplus, financial net inflows are actually helping us to finance the current account deficit. Yeah, so it's this inflows, the financial inflows are in the accounts of FDI. So we are having net inflows on FDI, trade credit, and ECB. But despite of the FPI outflows that we have observed during the first half of the financial year. So among the sectors where we see the FDI flows are generally broad-based. However, there is significant contraction of FDI flows in automobile industries, education, and metallurgical industries. And we also see that if we look at the relatively longer term government bond yields, like the 10-year bond yield, which is the right span minus 1 year spread, we see that the spread is declining. Even if we look at the other, for example, we see a continuous depreciating pressure on rupee dollar rate despite of RBI's intervention. So exchange rate depreciating because of the declining forex services, forex reserves. Forex reserves are so that there are intervention, RBI intervention, and the latest period. If we look at the during this September, there is quite a large amount of intervention. Yet we see that the depreciation continues. So decline in reserve. If we look at the relatively longer term government bond yields, like the 10-year bond yield, which is the right span minus 1 year spread, we see that the spread is declining. And exchange rate volatility has recently reversed. So that the RBI intervention were trying to contain the volatility of the rupee dollar changes, but it declined initially. But in the in the September quarter, we see that it has rebound. So it's actually not very successful in containing. If we look at the volatility, so that's what we have in our external front going. And now Dr. Radhika Pandey will discuss the monetary and financial sector.
Clarification. Very brief one. I just want to ask you about this. I didn't know trade. If we look at the relatively longer term government bond yields, like the 10-year bond yield, which is the right span minus 1 year spread, we see that the spread is declining. I will briefly talk about the monetary policy and financial markets trends over the last couple of months. So if we look at the RBI's monetary policy, it has been tightening. RBI has raised. If we look at the relatively longer term government bond yields, like the 10-year bond yield, which is the right prime minus 1 year spread, we see that the spread is declining. Even if we look at the other, for example, in Fed case also, there has been a yield curve inversion where we see that the short-term rates have risen much faster than the long-term. What's happening to the structure of interest rates? If we look at the 91-day T-bill and call money rates, they are the short-term rates and they mirror the trend in the policy rate. So we see that the call rate has been inching up. Call rate is the red line graph and 91-day T-bill is the blue one. So we see that there has been an upsurge in the call money rate and the 91-day T-bill rate. If we look at the relatively longer term government bond yields, like the 10-year bond yield, which is the right prime minus 1 year spread, we see that the spread is declining. Even if we look at the other, for example, in Fed case also, there has been a yield curve inversion where we see that the short-term rates have risen much faster than the long-term yield, and there the difference, the spread has turned negative. So that's there, but here it's still positive overall, but they're 0.5%. And therefore, due to this trend, we see that the spread between the 10-year and the 1-year bond has narrowed. The 1-year bonds and the relatively shorter term bonds yields have been rising. The 10-year bond yield has been relatively stable, range bound, and therefore the yield spread has declined, and this is true if we look at 10-year minus 5-year spread. If we look at 10-year minus 1 year spread, we see that the spread is declining. Even if we look at the other, for example, in Fed case also, there has been a yield curve inversion where we see that the short-term rates have risen much faster than the long-term yield, and there the difference, the spread has turned negative. So that's there, but here it's still positive overall, but there is a sharp decline in the spread. What's happening on the credit front? So we are seeing that non-food bank credit has seen a sharp rebound in this financial year. If we look at the period of COVID wave 1 and wave 2, we see that the incremental credit growth in each month was quite subdued. So this graph is showing the monthly increase. This is not outstanding non-food bank credit. This is showing the monthly increase in bank credit this month, October, and it's showing the constituents, the key drivers of credit growth. And if we look at the latest month, October, we've seen credit growth of more than 2 trillion in October, which is more than the average increase that we've seen over this financial year, which has been somewhere around 1.5 trillion. So credit growth has seen a sharp rebound, and it's primarily driven by personal loans and services. And within services also, we see that lending or loans to NBFCs have seen a sharp jump if we look at the composition. Another recent trend has been that the credit to industry has picked up, and though micro and small industries was showing a robust increase in terms of year-on-year change, but in the last few months, particularly since we sustained 2022, we have seen that the credit to large industries has also picked up. We need to see whether this is going to be sustained growth because there has been a trend towards deleveraging. Most of the companies have repaid their loans, so now there is a fresh demand for credit. That is one part of the story, and the other is that because of rise in input cost pressure, the working capital requirement has also picked up. So credit to large industries has been seeing a sustained rise, and if we look at in terms of outstanding credit growth, outstanding credit in October, 20% of that was accounted for by large industries. So this is a very notable trend in the credit growth that we've been seeing. The other important element is that the credit growth has outstripped deposit growth. We've seen credit outstanding year-on-year change in credit growth of around 17 to 18%, whereas the growth in around 8 to 9%. And that's reflected in both credit to deposit ratio as well as incremental credit to deposit growth. If we closely look at the credit to industry, what has been happening? So I'll spend just a minute explaining this graph. So the green bars is showing the outstanding credit to MSME in October 2019. That is the green bar. They have been mobilizing the credit demand through CDs, the certificates of deposit, but now they have also started raising the deposit rate. So going forward, the differential may narrow down, but as of now, we see that there is a big difference between the credit growth and the deposit growth. If we closely look at the credit to industry, what has been happening? So I'll spend just a minute explaining this graph. So the green bars is showing the outstanding credit to MSME in October 2019. That is the green bar. There has been an increase, but comparatively, credit to MSMEs has increased by more than the credit to large industries. One element of this is change that has happened from the pre-COVID year, October 2019, exactly 3 years, how the credit to MSMEs has moved and how the credit to large industries has changed. So we see that outstanding credit to MSMEs was somewhere around 4.5 trillion as on October 2019, and now it's 7.7 trillion, so roughly an increase of more than 3 trillion since the pre-pandemic level. So there change, though in terms of the share of outstanding bank credit, it's very small. It's just 5% credit to MSME. But we have seen an increase in credit to MSMEs from the pre-pandemic to October 2022. And comparing that with large industries, though there has been an increase, but comparatively credit to MSMEs has increased by more than the credit to large industries. One element of this is that already the base is high. Credit to large industries is around 6 times the credit to MSME. But if we see the movement from October 2019 to October 2022, we see that there has been an increase from 23 trillion to 25.2 trillion. So just one point that, relatively the credit allocation to MSMEs has been more than to large industries, banks. Whatever increase we are seeing credit to large industry is only in recent months. It's only since August 2022 that we are seeing credit to large industries. On the banking sector front, we all know that there was a time in 2018 when the NPAs, the non-performing assets of public sector banks, rose sharply to touch around 14-15%, and that was due to the asset quality review that was conducted by the Reserve Bank of India. A lot of bad loans were recognized due to the stringent regulations that were introduced, and since then we are seeing a decline in the NPAs of public sector banks. As per the RBI's latest financial stability report, the NPA ratio, which is NPA upon advances, was 5.9% in March 22. It's expected to decline to 5.3% in March 2023. But what we see, particularly if we look at the second quarter, we saw a sharp decline in the NPAs of public sector banks, which was due to a combination of a number of factors. It was due to increase in the credit uptake, improvement in the net interest margins, because your lending rate is much higher than the rate that you are paying on deposits. So net interest margin improved considerably, and also due to better regulation, and particularly if we talk about the regulatory forbearance that was introduced during the pandemic time, it was much more focused and targeted. It was not like a broad-based forbearance that was introduced during global financial crisis. So therefore, the repayment culture has also improved. This seemed to have improved in the current period. So combination of all those factors, we see a improvement in the balance sheet position of public sector banks. Market as well as through to the stock market performance. So the left graph is showing the returns, monthly returns on Nifty 50. We have seen that overall stock markets have been very volatile due to what's happening in other countries, what's happening to the dollar in market as well as through FPI activity. Thank you. Potential between the US assets and Indian assets, resulting in an outflow of capital from the Indian markets. So as a result, we've seen a period of volatility in stock markets, but last 2 months we saw positive growth in the capital markets in terms of the monthly change, in terms of the index returns. And that is also, if we look at the foreign portfolio investors, they turned buy market as well as through buyers in November, mainly due to net buying activity in the equity segment. There was a period when there were sustained net sellers, and that was due to, again, selling in both equity and debt. Even recently, we see that though FPI have market as well as through FPI activity. Thank you. Interest rates and stabilization of interest rates at some point in time. So that is one key takeaway. And also, even now we see that there is volatility. Even in the month of December, we see volatility in both stock market and FPI flows. But one noteworthy point is that though FPI have been volatile, the domestic institutional investors, the mutual funds have been supporting the market during this time, and only market as well as we see that FPIs turned significant net buyers. The mutual funds net buying was quite subdued. It was around rupees 117 crore. So that is one very important point, that when FPIs turn aggressive buyers, we see some moderation in activity, primarily due to market as well as through FPI activity. Thank you. Moderation in the global crude oil prices, leading to rupee appreciation. But at the same time, even though the Fed reduced the rate by 50 basis points, the tone was quite hawkish, and that gave this indication that interest rate hiking process is not yet over, and maybe terminal rate would be much higher than what was expected earlier. So therefore, we do expect the bouts of volatility to continue both in the stock market as well as through FPI activity. Thank you.
The personal income tax, the growth has been robust compared to the previous year, and this is attributable to improved economic activity and revenue side of the union government. The table shows percentage change in revenue collections during April-September 22 over similar period in 21, 20, and 2019. So we find that gross tax revenue of the union government in the first half of the current fiscal is around 51.4% higher than compared to H1 2019, which was the personal income tax normal year. And if we compare it with the previous year, first half of the previous year, we find that growth of all taxes have been robust, except union excise duties and customs. Looking at the direct taxes, the corporation tax and the personal income tax, the growth has been robust compared to the previous year, and this is attributable to improved economic activity and higher corporate profitability. On the customs and union excise duty front, the government slashed or reduced duties on petrol, diesel, edible oil, cotton, pulses, and etc. to curb inflation, which resulted in lower customs and union excise duty collections. From July 22, the government imposed a tax on windfall gains accruing to oil companies due to surging crude prices. The export of petrol, diesel, and ATF was taxed, and also tax was introduced on the domestic crude production. That was one way of trying to generate revenue to windfall gains accruing to the oil companies. The GST collections have been buoyant, and since March 22, the monthly collections have been above 1.4 trillion, and in the H1 2022, the GST collections were 38% higher than H1 2019, which was the last normal year prior to the COVID. And the robust growth in GST, which is shown in the strong shift, it's attributable to improved economic activity, high inflation, and stronger enforcement. And on the non-tax revenue side, we see a decline even as compared to the 2019 period. And the fall is due to monetary compression, lower profits, and strong shift from the revenue to the capital expenditure by the union government. So thrust on capital expenditure is there. So expenditure in the current fiscal banks to the government of India. On the expenditure side, we see a strong central government thrust on capital expenditure. Central government capital expenditure was 83% higher than what it was during the similar period in 2019-20. Even as compared to the last year, it was around 50% higher. In contrast, if you look at the revenue expenditure, it was around 14% higher, and also compared to the last year, the increase in revenue expenditure was just 6%. So there is a strong shift from the revenue to the capital expenditure by the union government. So thrust on capital expenditure is there. So expenditure in the current fiscal will be higher mainly because of, and this is the data from 26 states, aggregated across 26 states. So if you look at the story is robust growth in state taxes. So own tax revenue buoyant across states compared to H1 2000. Slippage in fiscal deficit, despite higher revenues, if any, should be tolerated to help revive growth, while RBI focuses on curbing inflation. So that is the point that we wanted to make here. Now let's look at what is happening at the state level. And this is the data from 26 states, aggregated across 26 states. So if you look at the story is robust growth in state taxes. So own tax revenue buoyant across states compared to H1 2019-20, which was the last big growth compared to last year during the first half of the year. And you find in some states the growth has been central transfers have been moderate, like Uttarakhand, Tripura, Himachal, Karnataka. The current year, there has been a growth in own tax revenue to the extent of 29%. But if you look at state-wise performance, we find that own tax revenue show a decline of 1.7% in case of Bihar compared to last year, and the growth has been moderate in case of Andhra Pradesh, Punjab. So you find there's a lot of variation with some states with growth compared to being very moderate. The other component which drives the state revenues is large growth in central transfers to most states. And that is shown by the second graph. The black dots show what has been the state-specific growth compared to last year during the first half of the year. And you find in some states the growth has in central transfers have been moderate, like Uttarakhand, Tripura, Himachal, Karnataka. But The increase in central transfers is driven due to devolution. So higher revenues at the central government is also translating to higher devolution to states, but increase in central grants to states have been very modest. It is around 2.6%, and if you see, there has been actually a reduction in grants during 15th finance the current year compared to the last year in several states like Haryana, Odisha, Rajasthan, Tripura, West Bengal, Uttarakhand, Bihar. So there are many states where you see actually a fall in grants. And a part of it could be due to the revenue deficit grant of the 15th Finance Commission in the first year, that is 21-22 of the final report. They had recommended about 1.18 trillion rupees as revenue deficit done, which in the second year it was around 86. So there was a reduction in about 32,000 crores. Then in many of the central sponsored schemes, especially NREGA and all, you find the budgeted numbers were much lower than what actually the revised estimates show. So you find there has been a decline in grants to the states. Now, government support on the capital side, capital expenditure side, we find that states' capital expenditure has been targeted. And the growth or the increase in capital expenditure aggregated across 26 states, which is shown in the graph, is been around 2.1%. And in fact, there has been decline in government support. There has been contraction in capital expenditure at the state level, and the budget, the government, Union government announced central support to states' capital expenditure through a 1 trillion interest-free capital expenditure loan. And as per the data from the Department of Expenditure, till end of October, around 60,000 crores have been approved for about 20 states, and of which 28,000 crores have been actually transferred to the state. So despite central government support, there has been contraction in capital expenditure at the state level, and this is an area of concern. For capital compression at the state level is an area of concern. So let's look at what is happening on the fiscal deficit front. So the table shows H1 fiscal deficit both as a percentage of H1 GDP and as a percentage of the budget estimates of these 26 aggregated across these 26 states. We find combined fiscal deficit in 2022 is declining both as a percentage of H1 GDP and also as a percentage of budget estimates. And if we look at what is happening at the state level, comparing H1 fiscal deficit in 22-23, we with H1 as percentage of 21-22B. So that is shown in that scatter plot where we measure on the vertical axis H1 fiscal deficit as a percentage of budget of 22-23B, and on the horizontal axis FD as a percentage of 21-22B. So and the most of all 45-degree line. So you see that with barring 6 states, which are most of all the other states are below the 45-degree line, which shows an improvement in fiscal deficit or fiscal consolidation in most states. Maharashtra and Odisha report fiscal surplus, while Andhra Pradesh and Bihar continue to exceed full year's fiscal deficit. So on the far right corner, you see Bihar and Andhra Pradesh. So the story at the state level is fiscal consolidation definitely happening, driven by buoyant home tax revenue and devolution, also because of compression in capital expenditure. And this is an area of concern going forward. So despite so states actually not spending on capital expenditure. To central tax revenue is buoyant. There is a strong central government thrust on capital expenditure. Performance of central government.
Thank you, Manish. We are running a little bit behind time. So which your commissioner will get overstep a little bit, but as Shamli has explained to us, inflation remains elevated and we are forecasting 6.3% for the year as a whole, though there has been some
Solution, increase in grants very modest. States capital expenditure has been targeted despite strong central support, and states are seen to be consolidating fiscally, but at the cost of capital expenditure. So I stop at that, and I hand over to Professor Mandal to.
Thank you, Manish. We are running a little bit behind time. So, with your permission, we'll get overstep a little bit, but as Shamli has explained to us, inflation remains elevated and we are forecasting 6.3% for the year as a whole, though there has been some moderation. That's drawing causality into what is just an identity. In fact, the causality could be running the other way because to the strong base effect coming out of the COVID shocks in the earlier periods. Once that base effect has now started fading, we are seeing that growth is quite rapidly slowing down. And our forecast for 23-24, that is next year, is that is going to be just a little above 5%. On the inflation front, again, as Yugani explained to us, inflation remains elevated and we are forecasting 6.3% for the year as a whole, though there has been some moderation. That's drawing causality into what is just an identity. In fact, the causality could be running the other way because it's not as though the imports are growing this year, taking us now to 6.25. And along with that, there's been strong liquidity tight. And this is mainly due to the slowdown of export growth. I'm emphasizing this because there is a somewhat simple-minded view that just because there's an identity between the fiscal deficit and the external deficit, that if you cut down the fiscal deficit, the external will get sorted out. That's drawing causality into what is just an identity. In fact, the causality could be running the other way because it's not as though the imports are growing. And that's reflecting in buoyant domestic demand. Imports are also coming down. It's just that the external situation is worse than the internal, and therefore exports are slowing down faster than imports. So it's a very complex situation in which we have to navigate our way and think of an appropriate macroeconomic stance. Our take is that since the inflation elevated, since it seems to have peaked and maybe moderating, it is the continuing slowing down of growth and this rising current account deficit which should probably be our policy priorities. So with that kind of perspective, I want to briefly recap in what Rajit has already said on the monetary policy side. A very large increase in the repo rate this year, taking us now to 6.25. And along with that, there's been strong liquidity tightening. And that has brought down the spread between the long-dated and short-term securities, as she mentioned. However, despite this, when you look at the growth in non-food banking, that is galloping away. It's growing very rapidly. Which seems to suggest that this tightening of monetary policy that is happening has not really passed through yet to the credit market and therefore transmission to the real economy hasn't yet really happened. So our view is that it's probably time to pause on this increasing of repo rates and tightening, further tightening of liquidity, and give more time for the pass-through to happen. Also, we have to see what happens as an impact of the forthcoming budget. before the RBI, comes back to thinking about further increases in repo rates and so on. So really, we're suggesting a pause there. As far as the external front is concerned, I think it is important to allow the rupee to gradually depreciate to try and deal with the current account deficit, which is enlarging. And RBI interventions will limit it to only containing volatility, which is actually what it has been doing. So that's uh, finally coming to the fiscal side, as Manish said, very robust tax revenue growth, and that enables the government, I'm talking about central government now, to increase its expenditure and sustain what has already been doing in the last couple of years, which is the strong thrust on capital expenditure. We hope that that will be sustained in the forthcoming budget. Now, if there is any fiscal deficit this year, despite the rising revenues, I think that should be tolerated. We would even suggest that in the forthcoming budget, not to set any very sharp tightening of fiscal deficit targets uh, to allow, some, how should I say, relax that to the fiscal deficit in the short term till this declining growth gets reversed, and then focus on fiscal consolidation over the medium term going forward. The other important remark we'd like to make is that this ad hoc tampering with tariff rate, which has been going on for 3 years now, and that has reversed, over 2 decades of tariff reform that we had in this country after the 1991 reform, liberalization reform introduced. And that we feel should avoid the tendency to do that, these protectionist measures, and instead rely on the exchange rate depreciation, which can achieve the same result without distorting prices through these tariff fiddling, ad hoc fiddling with tariffs. Now, a major policy concern on the fiscal side, as Manish mentioned, is that while most states have been consolidating their budgets and their spends, this has largely been done at the cost of compression of capital expenditure by the states. And this is really pushing the growth slowdown that we are seeing. And this is a major, as you know, actually states spend 2/3 of government expenditure actually from the states, not by the center. So what the states do on the spending side has a very important effect on macroeconomic outcomes. So for on this issue, we would suggest that the center start engaging with the states through the available institutions of cooperative federalism such as NITI Aayog, and nudge them, encourage them to adjust their fiscal stance. And in that context, if it is necessary, what we think is a really flawed FRBM design, both of the central and state governments, which are pro-cyclical, when really these FRBM ought to be counter-cyclical, that those, if necessary, can be revisited. And I'll stop there. Thank you.
So we move to the discussions.
Good afternoon, everyone. I'm Aditi from Wipro Limited. And first of all, congratulations to all of you. It's such a comprehensive, packed 1 hour of information and news. So my compliments to all of you. I made some notes while I was listening to all the speakers, and I just want to sort of go through them in order so that I don't be very. So I differ in some of the aspects, and I agree to some of the others. So I'm going to go through both of those. So first, going back to the Q2 GDP data, just want to point out that one of the reasons that we saw manufacturing and mining contracting was actually because of the commodity price effect as well. So volumes were not as bad when we looked at the IIP data, but there were two issues in the GDA data that led to a contraction. One was that commodity prices were way higher than last year. And second, also wages had grown a lot in this period, so that would have also had some impact on the EBITDA margins of corporates. And how commodity prices actually move now in the next few quarters will very seriously influence the GVA growth of these sectors. So it's actually harder to really give a clear outlook on how, for example, what will manufacturing GVA growth be in Q1 of next year or Q2 of next year, because we don't know what to model commodity prices because of the geopolitical issues. And absolutely agree, trade, hotel, transport and communication finally above pre-pandemic levels. And, that I think is an engine of recovery that is going to continue for some time. Normally, see, I've been with a rating agency for 15 years. My role in the market is to take away the punch bowls. It's very rare that I'm more optimistic than the broader view in the market, and this is one of those rare times. So I would urge October data to not be seen in isolation, because we had Diwali early this year compared to last year, and it has completely distorted all the October numbers. If we now look at November in isolation, and we are starting to get a lot of the high frequency indicators, there is a rebound almost everywhere. And when we average out October and November, most sectors were not really that much worse off than what we were in Q2, despite a base normalization and despite an external sector which is clearly slowing down. So we had, we have our own ICRA business activity monitor, and we just released the November version yesterday. So if we look at the October-November data average and we look at the YOY growth compared to Q2, it's come up from about 12% to 10.2%. 10.2% is still quite good. And these are all volume indicators. If we look at how the performance was in October-November compared to pre-COVID, and we compare that Q2 compared to pre-COVID, we're actually
10.2, you mean in nominal terms? In real terms?
Yeah, so I'll tell you what all we have in this index. We have the entire auto basket, we have vehicle registration, we have coal, electricity, diesel and petrol consumption, rail freight, we have exports, we have cargo traffic, and we have also got deposit growth and credit growth. We have 16 indicators, and all of these, the GST bills. So all of these are pretty much volume indicators. So things like, for example, your other than exports is the value indicator, and credit and deposit is also value. But if you look at GST bills, those are also running at a very high double-digit growth rate. And in fact, I don't know if that laptop is connected to the internet, maybe I can just pull up my report at the end and show you some of the charts which we've done. So so the momentum in many ways has not collapsed. And I think that's something that we should keep in mind. Now I'm going to offer a few more anecdotal, things that I can see with my eyes that may not be any data. I thought sentiment in the Diwali season was way better than what I had expected at every price point, including the most low-end Diwali Mela that we had in Archipelago, which was just flooded with people. I mean, post-pandemic, to see a sea of people like that, I was frankly quite alarmed, but so be it. Where and spending was high in the Diwali season, even for the lower income classes, despite inflation being where it is. Where I can really see an impact is rentals are going up. So there is a complete transmission to low-end rentals, and I think that's where it's going to pinch the disposable income. Broader also sentiment, I think, is running better than what we can get to see from the RBI's survey. Just again, some anecdotes. My office is in Cyber Hub, Cyber City, so we overlook Cyber Hub, and I can tell you, restaurants are just full, and there is nothing more discretionary than eating out. So it's people are ready to make these choices right now. I have to go to Mumbai tomorrow, and my hotel price and my tickets are exorbitant. But travel is back. People are traveling for leisure, for business. Wedding season is back, and these are all sort of big drivers in pockets. So even at the lower end, I feel consumption is it's somehow managing to sustain. Higher end also, I do see a lot of anecdotal evidence of there being a sustained desire for consumption. Big impact, of course, is going to be on the external sector. So we again averaged out October and November. So we recently got the trade deficit data for November. And what happened in October was that we had a sequential downturn in both merchandise and service exports, which is what I talked about. But imports also came down very sharply. And again, we felt that this was a environment. So the rebound in merchandise exports in November is there, but it's mild. And imports have gone up a little bit more strongly. But the deficits for these 2 months are actually running at a rate which is lower than Q2. So we feel the worst quarter for the current account deficit will be Q2. Our point estimate for the deficit calculation is $32 billion for that quarter. And this quarter we feel will be in the mid-20s. Without December, I mean, how much exports actually sort of get curtailed in the Christmas month, I'm not so sure. I suspect a lot of orders have been booked and shipments will happen. If inventory doesn't move during the Christmas season, then we will start to see a much sharper impact on that in the next one. So as of now, we are looking at second half current account deficit being lower than the first half. And financing, what we feel is that the global sentiment has been the really big driver of what's happening with flows. So I'm just going to skip forward. Maybe I'll come back to talking about inflation and what Radhika was talking about. FI equity flows are completely being driven by sentiment. But to a large extent, I don't think sentiment is going to go back to being as weak as it was in the period up till July. So we are not expecting to see sustained outflows. There's always volatility, and on average, I think we should be back to a position where average inflows should be $2 billion per month, which is a very healthy situation for India. My personal feeling is that the debt market is a dead market. Neither is money going to come in, nor is money going to go out. FIS brought in a lot of money into our debt market when we were at a peak of our repo rate, and it was clear that it was going to crash after. All that money which came in, I think in 2018, 2019 has already gone out. So now neither is much money coming in, nor is much money going out, which is why I feel interest rate differences just don't matter. If they mattered, our 10-year bond yield should have been much higher than what it is. They just don't matter right now. But of course, the outlook for monetary policy, both globally and domestically, is going to have some impact on the 10-year bond yield. It's not really going to be a one-to-one correlation. And fiscal, I'll come to fiscal a little bit. There, I don't see any major concerns that are going to drive the 10-year bond yield in any case. Then on the bank credit, just a few sort of thoughts that we have. One, working capital has really driven bank credit. Secondly, ECB also seems to now be getting refinanced domestically, which is pushing it up. Three, shift from the bond market to the bank credit because the transmission was much faster to the bond market. And going ahead, the numbers are now going to start tapering off. So Radhika showed us this huge incremental credit which was there in December of last year. Once we get over that hump, the YOY growth rates are going to really sort of normalize. Also, we might find that now that transition is taking place. Even yesterday, one of the big banks increased their FCLRs. We'll also shift back to the bond market. But ECB market, I don't expect that companies are going to want to tap. So, that will have to be done domestically, either through our bonds or our bank loans. Then on the DXY, so now I'm kind of skipping backward and forward. Okay, first on inflation, our views are fairly similar. We're looking at inflation being 6.6% this year and 5.2% next year. And in terms of the question of what the RBI will do versus should do, I feel the RBI should pause, the MPC should pause, because even in the periods where there are no base effects, we are projecting growth to at best be 5%. And that's well below what we feel the potential GDP growth should be. What will they do will probably be driven by the next few inflation readings, although we do expect a considerable easing off on the inflation side. So would and should are probably different answers right now. So I'll leave it at that. Few thoughts on the DXY and the INR. So basically, we had the DXY topping out at about 115, and the INR crossed 83 at that point in time. The DXY has now come back to 104 to 105 levels. Rupee corrected to 80.50, but it's gone back to high 82s. So I feel that there's probably a lot of intervention that the RBI is doing now and now we can live with it, right? They used to an 82 handle for the rupee. So let's just go back there and take care of some of the appreciation which has happened against other currencies. I suspect that's what the thought process is at this point in time, and exporters are probably happy to have the rupee in an 82 handle. And the reserves, possibly the revaluation impact was less understood. And so it seemed very alarming how rapidly our reserves were coming down. But with possibly limited intervention, we've already recouped about $40 million on the reserve side. So again, this is, we are a taker over here. This is happening, as the volatility is there in global bond prices and in the currency exchange rates. A lot of movement in the foreign exchange reserves will happen automatically, and maybe we should be sort of less alarmed by these movements. Then coming to the fiscal side, so as some of you may know, my original bread and butter is fiscal and state fiscal, so topic very dear to my heart. So I'll just offer some thoughts. The revenue growth story on both the state side and the center side, it's basically the positive fallout of the patient. The large companies are gaining at the cost of the unorganized and the informal, and large pay tax. So, that's showing up in both our direct tax numbers as well as in our GST numbers. And I think, structurally, this is a very good thing because again, I come from a rating agency, and one of the biggest issues in our case is that our tax base is just too small. So anything that structurally boosts our tax base is probably good news. On the capital side, one of the reasons that our capex was budgeted to go up this year is because a lot of NHAI capex was actually not on budget. So it's not a very like-to-like comparison when we're seeing the YOY growth being as high as it is. But anyways, Government of India capex, to put it in a different way, the average required to meet this year's budget expenditure, we're only slightly lower than that. And that's because the state scheme has been so tardy, very frankly. Why is the state scheme being tardy? This is something that we looked at in great detail at ICRA. So our interest in state governments is that we have a lot of ratings that get linked to state government credit quality. So we actually look at this at a state level in great detail. And so I'll come back to a couple of other reasons for why the state's own tax revenue growth has been high, and then I will delve into my thoughts on the capex issues. So one K-shaped SGST is doing well. Petrol and diesel prices are very high. The sales tax growth is high. Many states actually increased their excise duty rates during the pandemic because they thought that was a sitting duck. So we are going to take advantage of it. And stamps and registration collections are doing well because millennials finally realize the value of owning a home instead of just renting it. So lots of positive factors for state revenues over there. One, big sort of positive which Professor Gupta talked about was the central tax resolution. Now, this is actually a very interesting situation. Since the pandemic started, since the second half of FY21, my feeling is that there has been this lack of conviction in the revenue upturn. So we have systematically underestimated revenues in the budget and the revised estimates, and actuals have been better than expected in these years. And what happens when the Government of India underestimates its tax revenues is that it underestimates tax revolution, and then you have a catch up which happens later on. So last year, almost half of the tax revolution was given to the states in Q4. Now, when states get money, all of a sudden they kind of don't know what to do with it, and borrowings crashed. I had multiple mutual funds who invest in state government securities call me up and scream at me about why they were not coming to the market to borrow. And it's because they suddenly had all this money. And when states get money in Q4, they cut their borrowings, they can't spend it on capex. They carry cash to next year. But the next year they have a fresh fiscal deficit target to attain. So having extra cash doesn't actually help you. This is another reason why there were almost no borrowings in one of this year. One more reason for that, which I'll just come to. Our estimate for central tax revolution this year is that it's going to be 1.1 trillion higher than what Government of India budgeted. We got two double tranches of tax devolution which came through in August and in November. And we estimate that there's still 3.8 trillion to be devolved in the last 4 months. So a lot of money coming to the states. And every time there is unexpected release of funds from the center, state borrowings crash in the next few weeks. So that keeps happening. Grants may have been low this year also because of the GST compensation. I think there's a timing issue over there. So that could be one of the reasons. And one major change which happened this year, at the end of March, Government of India sent a letter to the states where they tell them their net borrowing ceiling. And this year, the state probably got a very big shock when they realized that off-budget borrowings are henceforth going to be equated with their own borrowings. And because many states just didn't have a borrowing permission in Q1, that's probably another reason why capex they had to be very judicious with spending in the early part of the year. Now, we really welcome this change. In fact, last year we were alarmed because we were hearing from a lot of bankers that off-budget borrowings were being undertaken and it was a completely non-transparent part of state finances. So we really welcome this change. But of course, it led to upheaval in the early part of this year. Now, coming to the capex, so the states had already budgeted for a 40% rise in their own capex. And and many states had actually not factored in the 1 lakh crore loan into their budget estimates. We can't find the line entries in their own budget estimates. Last 2 years, the amount was only 15,000 crore. So probably the states were themselves unaware that there was going to be this large amount of money that was suddenly going to come forward. And if they got to know on Feb 1, their budgets were probably at a very advanced stage of preparation. So I suppose they just couldn't really plan well enough for this money which was going to become available. So again, it's a revenue visibility issue. So we have two suggestions, if anybody cares for them. One is that if the capex scheme has to be continued, then possibly the states need to know the amounts before the budget so that they can plug it into their own budget. And the second thing is that, the world is uncertain and tax revenues may deviate meaningfully from budget estimates going ahead as well. Perhaps it would be better if the government of India, once they have their advanced tax collections every quarter, if they can sort of revisit in that last 15 days of the month, or 10 days of the month, revisit what will be the likely devolution for the next quarter. Let the states know so that they can actually plan their borrowing for the next quarter accordingly and then let RBI know and let the market know how much money they're likely to raise. So I suspect if things like this are sort of communicated, possibly states will actually be in a better position to ramp up their capex. Now the space they have for spending is huge, but can they actually ramp up spending in the second half of this year? I have my doubts. And one issue is execution capability, the other issue is revenue controls. So if we can sort of make this revenue visibility better and get the states on board, then the fiscal impulse of the tax revolution can probably really be ramped up and of the capex loan scheme as well. So second half of the year, we are slightly higher than the market consensus right now. Unless there is a major commodity price shock going ahead, I would still expect growth to be about 5% or thereabouts in the second half of this year. But of course, the big shock now is going to come in from the external side. How quickly that seeps into our real growth in terms of volumes. But at the same time, if the global economic activity is going to collapse, then commodity prices will come down, and that's probably going to help a consuming nation like India. So I'm still hopeful that net India might be a lot better off than many other countries. So I'll stop here. Thank you so much.
Thank you, Rbi'S. So we move to the next discussion.
Thank you very much. So I think for Vivek, who's mostly concerned with economic theory or actually more long-term developments in the economy, it's difficult not to be like a bull in a china shop to be presented with such fantastic data. It's really valuable for me to get very updated data on the most important aspects of the macro economy at any rate. So I just want to make some very brief, well, I want to express some thoughts on what were presented, the points that were presented, and I want to just, after that, make some very general comments, which I'm not at all certain will have any bearing on the budget, frankly, but maybe on the management of the economy in general. Yeah. So, Sudipto, you're absolutely excellent summing up the global situation at the very beginning, not the with which you started, which I really enjoyed listening to. I just thought one thing was missing there. I mean, it's that the global inflation, even in the West, interestingly, including the United States, which is a surprise to me, is that food inflation was quite high. I'm completely surprised. I would never have thought that. To me, I mean, it's a puzzle. It's not something that I'm pointing out is missing in your presentation. But that's a puzzle to me, I must say, because I've never thought the United States would be short of food. Of course, and the United States, unlike India, I don't think is dependent on Ukrainian wheat or oil seeds. We are severely dependent as far as oil seeds are concerned. So that again is a bit of a puzzle to me, and it's kind of interesting. In fact, all over Europe, even UK, food inflation is quite high. So yeah, that's a general thought that comes to my mind. In India, I'm not surprised, but globally, I would be surprised. So let me just go on to the points that were made. Rujani, I think you're right in mentioning MSP. Something we'll not discuss with all these days. That's of course also because this government has not raised MSP in as aggressive a manner as towards the end of UPA 2, for instance, which immediately showed up as high inflation. You're right, of late it has been raised quite high. But I just want to point out that, of course, it's standard practice now for any economist who's to display his savvy to talk about core inflation. But I think core inflation has an independent status, at least empirically in India, because core inflation is driven by headline inflation, in particular food. And is that surprising? Because wages are driven by price of food. Wages are in the agricultural sector. So anyway, I just thought I would say you're not doing anything unusual. Everybody's talking about it. So I'm trying to say to similar inflation driven by food, core, and energy. I don't see any independent status that core has. The other thing I did learn from the presentation that trade credit is an inflow in the balance of payments. That's to me, I was quite struck by that. Radhika Pandey is again very interesting data. Credit to MSMEs is very strong. That's probably not very widely known among commentators. Huh? That's an interesting and tremendous increase over the past year. That's really quite interesting. But your point about but in the case of large industries, the increase is not too much. It just seems to me that large industries are probably also, finance quite a large part of their investment and working capital by internal funds. They're probably not so dependent. But anyway, the point about MSMEs is quite interesting to me. I didn't know that. Now, I'm not sure it was just presented for a minute. The NPAs, and you had the NPAs, right? But it's kind of interesting, despite the improvement, in particular in the public sector banks. NPA is still, you can correct me, the way I read the data, NPA is still higher than 2010. Huh? That's quite strong, isn't it? That's quite, so the general cleaning up that we've been reading about, etc., is probably not being that great, it seems to me. Yeah. And the final again is a point, again, is something which become de rigueur now. But I guess it's sort of old-fashioned economist. I've sometimes wondered what the point of it is always. The time, the information on FPIs, portfolio investment, and your very interesting observation that actually, not surprisingly, FPI, that is not observation, the data present, FPI is highly volatile. And the market may have been stabilized by domestic mutual funds. So, I don't know. I just don't know why so much time spent on FPIs. Except unless, of course, you are working in the financial sector. From the point of view of the economy, it's not clear to me. But of course, you're right in having presented that because I guess by now, it's, as I said, de rigueur, and anybody who talks about the economy must talk about inflows, etc., whatever the impact, capital inflows, external capital, to be precise, to be seen as being credible in some way. And the other, is it from you or is it from Manish? Manish's present. Manish, I also really enjoyed the presentation, the interstate thing. And I also think that NRPFP is really uniquely positioned to actually make some very intelligent observations on this. Many of the things that I saw in the presentation we already discussed. Philip also brought it up that the states are tardy. I think is that an expression you use? I don't know, but that's correct in capital formation, expenditure on capital formation. Now, what I think I'd be interested in is how much of it is that they are just tardy, period, and it's possible, entirely possible. And unlike a lot of people in Delhi, I live in the States 6 months of the year, so I'm seeing the beast up front. Sometimes I really, what's the right word? Despair whether there's any kind of economic management going on in the state that I live in. That's probably the case in many of the states in India. And I really would be interested in knowing that. But how much I'm also willing to give a benefit of the doubt to the governments of states like Kerala, or at least willing to listen to them. But NRPF is probably the place that can sort it out for us decisively or definitively. How much of this, the fact that they're not spending on capital expenditure is due to the fact that the center is denying them their rightful due, either in terms of the transfers that ought to be made, or unnecessarily putting in requirements about about borrowing requirements or conditions about borrowing requirements, or budgeting even. Though I certainly believe that it's a fiddle to borrow off budget and not sure if that it counts. But I just would want to know what are the rights of states in this. For me as a citizen, I really want to know this because this is an important issue. Because there are announcements of states constantly saying that the center is preventing us from doing all the wonderful things we want to do. I really be interested in that. I don't have the competence to figure that out, but I think as a citizen, that's very important. And now the other thing, Manish, data, I thought public capital formation 50% higher. That's really believable when I look at the numbers, even without seeing yours, but yours is what mentions the figure. I can't help thinking that nothing focuses the bite as much as in the next year, because for at least 6 years of their tenure, the present regime has been telling us about the virtues of fiscal restraint, or more fiscal restraint, crowding out, and all the rest of it, and that, and the absence of. I've actually had somebody say this in the presence of Mr. Jaitley, actually, the then chief economic analyst. Oh, by the way, we have no shovel-ready projects. But now public investment rises by 50%. I guess better late than never. But I'm also so really this is a kind of interesting deviation of the government's position so far. They didn't expand what they really should have, which has been the height of the pandemic, which was when a lot of this was being put out about fiscal responsibility and so on. I mean, there's nothing to do with economy. Don't worry about these sort of things. But when I live in one of the states, and I just see the natural environment just being gouged down, yet another 4-lane highway. Sometimes worrying about too much public investment. I'm serious. I mean, though, as a trained macroeconomist, I suppose I'm expected to rejoice in that. Not you've been reading about, the highway system. I'm not just talking about Kerala, Uttarakhand, and the destabilization of the hills. And I've just read in today's newspapers actually. A 2-kilometer bridge has broken in half, not just broken in half, even before its inauguration. And, before the UP elections and a week after the highway was, inaugurated by the Prime Minister, it was full of potholes, which a BJP MLA flag, actually. So I'm just trying to say, I think the time has come also to ask about where is this public capital expenditure put out by the central government going? Do the states have a say in that? Is there a reasonable amount of impact and environmental impact assessment going to this? It's just some thoughts that come to my mind. Obviously, we get no trials of attraction in financial circles or budget making circles, but as a citizen, I worry about that very seriously. Finally, Manisha, did I see that excellent graph of yours right? GST in September 22, not much higher than September 21. Is that possible? No, that's not possible, right?
This is year-on-year growth.
These are growth rates that you're seeing.
Huh?
These are
growth
growth
rates.
rates. Year-on-year. So compared to last September, what?
You can see the same growth rate.
You can see the same growth rate. Yeah, just a sec. Yeah. So you can see the same growth rate in 22 September and the same growth rate in, but yeah, quite right. Not the level, yeah. So,
Yeah.
but even the growth rate not being higher is kind of a bit of a surprise to me, given what we've been reading about GST collections being buoyant and a reflection of the economic activity. Wouldn't that be a reasonable interpretation of part? If the growth rate is not much higher,
Yeah. So
then can you maybe take it as use that to infer something about the state of the economy? I would. Yeah.
I would think even last year you would be having a reasonably high growth
Correct.
in GST collection.
Naturally, because the year before that was a pandemic year.
Yeah. So
That's
if you're
correct.
sustaining the same high growth rate now, then you'll be confident that you're doing well.
GST collections are running well ahead of the budget.
That yes, but that is fine. But that could be for variety, compliance, and all the rest of it. Yeah, inflation, compliance need not be state of the economy is all that I'm pointing out.
Yeah, well, e-payments are also running pretty nice.
GST water running.
E-payments.
E-payments. Yes.
But the GST levels have stabilized, like they're flattened, they are not exactly going up. If you look at the levels on every month, it's around 140, 144,000, has varied around
In
that.
fact, I would expect them to between 145 and 155 in the rest of the year and pick up in the quarter ending, basically the month where you report the quarter ending number. But that will still give us at least a 1.3 to 1.4 trillion increment over the BE for CGST.
Right, that really is. I mean, I have a few more now. That's about the comments of the presentation made. All of them I found very interesting. So I want to make some very general comments about the economy slowing. You presented it very well. I just want to say that that's a concern, all right. But I think in all this assessment, there is not enough of a sense of how unemployment is doing, given the not from your presentation, but I mean in the discourse of the economy, including stuff coming out by commentators, whether it's a government, the financial market observers, there's so much of emphasis on inflation, nothing about unemployment. I just looked at the PLFS data, and it's kind of interesting that yes, it's probably come down in the past year, but the July, September, which is most of the recent data, and of course you have it only for urban unemployment, you don't have for rural, and therefore you don't have for the economies. It's still higher than marginally, but it's still higher than the pre-pandemic year of 2019-20. So I think it's useful in general to at least flag this and say you can't. I don't think economy can be run only in terms of the assessment of inflation, however interesting that is. Maybe. So I just have a comment to make and a puzzle that I want to puzzle, or just something that I want to reflect upon. Something which is not apparent from the data yet. The comments about monetary policy is coming a great deal so far into the discussion here and in general. I think it's probably run its course as far as in the sense that we are seeing inflation down, but that's really due to lower global commodity prices. Food inflation is also slightly lower, but not in a very significant way. The domestic components of food.
But WPI food articles is
negative. That's right. But I would say CPI, which is the main components which are showing high inflation, I've noticed are cereals, vegetables, and spices. Right. I do think spices is so important, but the figures that's been flagged. I'm just saying the domestic components of inflation seem to not have abated fully. Global components, commodity prices, oil and edible oils are.
Yeah.
Thus, oil certainly lower than it was even before the Ukraine war.
So cereals pulse is due to MSP hike. So there are different things.
But the MSP hike made in April, just before the Rabi season, as you said.
The hikes were announced during the last budget, but the crop cycle is different.
Right.
So it has now been affecting the prices
Right. Except vegetables. Anyway, so I think I'm not sure monetary policy has had much to do with the decline in inflation, and especially as usual, credit growth has continued quite a lot, unabated, has increased in fact. However, on the general use of monetary policy, Sudipto spent some time on it. I just want to point out the only way monetary policy can control supply side driven. I don't want to use the word supply shock for a deliberate reason. There is an underlying inflation in India, food price inflation in India, which has nothing to do with shocks. It has to do with the fact that supply is not matching demands. And that is the underlying food inflation. There's no other way. I mean, supply is not. If food prices are driven by market forces, then supply is not matching demands. And I think it's really happening because supply is falling short of demand. And that underlying inflation just is not a shock. It's something which is underlying the economy. And the only way the central bank of any country can control that is, of course, by contracting demand, as you all know very well. So I'm just trying to say, whatever welfare gain that you have in terms of bringing down the inflation rate, it will be matched probably by raising unemployment or reducing output in the economy. So just the net effect is probably zero, but you would see lower inflation, but nobody sees the net effect as zero in some ways. So I think that's a general comment that I want to make. Now, the final point that I want to make, the other reason is that about unemployment, there have been phases in India where fairly high growth have been possibly, and I'll say why I say possibly, matched by stagnant aggregate consumption. I just want to say, in real terms, I want to refer to the Consumption Expenditure Survey of 2017, which the government did not release, but of which now some is out, copies are circulating on the net. So that was a time when actually growth slowdown hadn't happened, but real consumption fell. But that's not a puzzle at all, because that could happen if the income shifts unfavorably. So I'm just trying to say, I would also, evaluate an economy on the basis of how consumption is doing and what is happening to unemployment, and not just worry about inflation. A lot of the public discourse on the economy it is. Now, the final thing that I want to say is that I did flag it earlier. I would be interested to know what this very high increase in public investment is doing to private investment. I'm just curious, it's also talked about, in fact, the finance minister spoke about this after the last budget deficit. She spoke about crowding in and happening via private investment. That data is not in as yet. I have slightly possibly different data from what Manish presented, in the sense that the Q2 GDP figures from the government show a 15% increase in, of course, you showed it for the public sector alone, or the public budget, but the economy as a whole, gross fixed capital formation is higher in real terms by 15%, which is very, very high, right? 15% is unusually high. I'm just curious what is happening to private investment, for which we have very little basis to say now. Does CMI give quarter-to-quarter data? I don't know. Does it?
We give data on project announcement
Yeah.
Quarter-to-quarter, or literally monthly almost?
No, quarterly.
So that's something which we can get. I'm just curious what that looks like.
So I was
For my-
checking the projects under implementation.
Right.
So that's increased for the first quarters, but
Uh-huh.
now there is a little bit.
Oh, I see. It'd be nice if you could have presented it, but that would be because you're one of the few people who probably have the ability and the intelligence to do that, but we'd be very interested to, I would have been very interested. But projects happening, I don't understand that.
This project under implementation.
Under implementation. If the investment in that increase.
Yeah.
But fresh investment, no, we don't have data.
No, there's new projects also.
New projects.
New project.
I have new project announcements.
Ah.
And that data had spiked in Q3 and Q4 of last year and then tapered off in Q1 and Q2.
Oh, see, of this.
This year.
Oh.
But I can assure you it's going to spike completely in the current quarter because lots of states have had their global investor meets. And massive amounts of projects have been announced. But that doesn't mean they're going to get executed right away.
Yes.
They have to take
So
this.
it was, so it spiked in terms of, announced, but not in CMI. That makes very little sense for them to do that.
So you have to look at whether you're looking at the announced or under implementation.
And they give you.
They give number of projects just stalled.
And then next completion. And they give a cost also and number in terms of cost, in terms of number.
The MOSFI actually publishes monthly data also.
Right,
They
right.
can track the number of infrastructure projects.
Right, right. And finally, if I may, Aditi, I like your point about your explanation of lower manufacturing growth, and you say that it's coming from value-added data. You're absolutely right. It is. And you're telling me that it's not reflected in the IFP at all.
So IFP is volume.
But this decline is not reflected.
So the volume growth is low. But it's still positive for
Oh,
the
it's
same
positive.
quarter where you have a contraction in the
In
DDA.
each one for
Yeah, Q2.
Q2.
We had a contraction on the manufacturing DDA.
Correct.
And for example, cement. So any sector which has a huge component of energy in their raw material cost
Right.
had very terrible earnings in that.
Right.
Now it's for construction companies, typically Q2 when you have the monsoon on, activity is low. So there is also no pricing power. So if raw material costs go up in Q2, where you're a price taker, you can't increase your output price.
That is
So
true.
you get completely hit on the margin.
But for the manufacturing sector as a whole, you can't say they're price takers now. And
There are lots of pockets. Anybody that has a natural gas,
but they could pass it on. I mean, I'm just trying to say they need not be price takers. That's all I'm trying to say.
So it's when we looked at the corporate data sector-wise, the situation was quite different. Within manufacturing, what pulled things down, one was the steel sector. Steel again, we had the export duties which came in. Global growth started slowing off. So again, there was not much pass-through which they could do. Cement was, I think, and mining in general. Mining companies were very badly hit. So FMCG numbers were not so bad. Durable companies also, auto sector numbers were good. But when we look at it, these are some of the reasons that brought it down. And if you look at the commodity, the Bloomberg commodity index, that was trending below 100 in Q2 of last year. And it spiked at 130 in July. And then it tapered back down to 115 levels.
Yeah, of course, I'm aware of this mechanism fully, but I'm just saying that I would be surprised to be able to explain, if we can explain the entire decline of 5.8%, right? 5.6% manufacturing in terms of higher commodity prices. That's all I'm trying to say. And it's apparently it's a bit of a puzzle that manufacturing does so badly when aggregate investment is rising by so much, 15% in real terms. So, thank you.
Thank you so much. Excellent discussions. And just one comment about
Please.
the MSME. So actually, when we are tracking the credit during from the pandemic
Right.
time, so actually government announced a lot of credit
Schemes.
the schemes
Well,
for
during
this,
the pandemic.
during the pandemic.
But they were only backstops, right? So they were only backstops that we pick up the tab if the company defaults. That's all. That's all the RBI. Sorry, they guarantee. So they are what in financial terminology called backstops. I mean,
Yeah,
but
again, if you
but
look
this is
at
actually lending has increased. Sorry.
if you look at the medium and the small, micro and small,
Yes.
so medium actually picked up. It's not
But not
small
I see
and
not
micro.
across the board.
Yes.
I see. But even then, I'm just trying to say this is not widely known that that sector as a whole
Yeah.
seems to have. That's all I'm trying to say. That was new to me anyway. So.
In terms of share, it is still low, but what we see is that there has been a pickup in
Right.
as an MSME segment as a whole.
But is MSME small? I mean,
It's-
if you use the word unorganized, isn't it fairly large part of the non-agricultural manufacturing sector?
No, she's saying small as a percentage of total credit. They still don't command a large part of the credit,
Right.
but they have
Yeah.
experience.
On their own, very grown.
Yeah.
Formal trading, that's
Yes,
what
then-
formal
yeah.
trading, yeah.
Yeah.
Okay, so now we move to the chairperson.
No, I'm one of the audience today. No, I was just trying to understand that there's so many things happening and there's so many things studying in so many different ways. So, at the end of the day, I'll go back to what Aditi said about K-shaped recovery and try to see whether I can find. I like that description. It's easy because it appeals in our perception of how of how GST played out, how pandemic played out, and so on. But it's sort of uncomfortable how to understand how we say that expenditures are picking up, the spending sentiment at the lowest end is still high. If we are talking about a K-shaped recovery, and if we are saying credit to MSME, presuming there is that is not the upper end of the market. So how do we defend this whole multiple indicators? So it does appear to me that if we say K-shaped recovery, the revenue story is very nicely sorted. That we formalize from informal to formal, the informal actually got hit, the formal picked up the space, and therefore we get good revenue story. But it doesn't say why, from your anecdotal evidence or from overall growth in expenditures, the lower income category is still reporting positive sentiments, and how we would account for Radhika's growth in MSME. So that was, I think, what I was sort of trying to put my head together. I think all of these discussions for me throw up more questions than we can answer, but I guess that's the fun of it. I'll stop there, but if
Can I just add one thing?
Sure.
I think another thing that very anecdotal, but I'm very certain this is correct. A lot of entry level contact intensive basic jobs are back. Now that we're back to office, back to school, sort of back to normal, people who were probably just living on free food for the last 2 years actually have jobs. And that is also something that is supported by consumption this year. Like bus drivers, in our offices, all of our housekeeping staff, shops, cinema halls. It just saw no activity in 2 years. So possibly people who just went back to their villages, stayed there for a couple of years. We saw the land that's being sold going up through the pandemic, because I feel there were just people who were there in the rural areas and we had upward also. So very good combination. Now a lot of those people have probably come back to the urban areas, and in fact the Kharif area fell compared to last year, which is what we were expecting to happen. So with those additional jobs, I think spending is getting sustained.
so, we are not even looking at a K-shaped
That's right,
recovery.
and it's not case shaped, right?
K-shaped is of the manufacturing side, that the larger players are gaining at the cost of the smaller players, because people do want to sort of shift towards having branded products, packaged products, particularly food items and things like that. So that's what we feel on the production side. But on the income side, people who just had no jobs and no move for 2 years probably at least have their basic jobs back, and I think that is driving a lot of basic goods.
Yeah, so because when I was saying that core inflation is driven by the demand right now. So it's actually, if you look at a core inflation basket, as you were saying, it's not independent, but if you look at the basket only, it's like clothing, footwear, then the miscellaneous, which is like 28% of the CPI basket. If you take out some part of the diesel and petroleum out of it. So it's all, it's like,
Consumption goods.
yeah,
Non-food
it's
consumption.
like household goods and services, which are like, it's all the daily kind of things. So also now, all this inflation on all these things.
Actually, I mean, for argument's sake, but they also pay wages which are dependent on food, and that's a point. That's how it enters in, not in not in that
We
index.
are talking about the pass-through.
Yeah, I mean, that's the technical word, but yeah.
Yeah, he's making analytical.
Actually, I want to add.
Yeah.
This point, we do the sincere business expectation survey,
Uh-huh.
and we were capturing whether there was a pass-through or not.
Mhm.
At least in the September one that we did, we didn't see any evidence of pass-through yet.
How can you get that from an expectation set?
Well, we were asking for cost sentiments,
I see.
whether their sentiments about wages are going up, and we were also asking them about overall inflation expectations. So we're drawing a correlation between that. We're not asking them exactly this thing. So from that, and we've been asking them since the pandemic here. So that correlation suggests it. I'm not saying it's not has not yet
Right.
translated.
I just read the kind of stylized fact econometrically, a core is affected by like, in particular, core is affected by food, which makes perfect sense also. I mean,
But sir, in this particular case, I had a question.
Right.
Don't you think the supply side factors, the global supply side factors, the supply
yes,
chain factors would have affected core inflation in this particular case? Not just the food, I'm not.
I'm not saying no, but they could have. They could have. They could have. How would they affect it? Again, they must affect it via the general price level, and wages, etc.
CPI basket is almost non-traded. So how can the global prices would?
No, I'm not making that point. I'm giving a possible channel by which what was raised can work.
This when they were all over the place, there's nobody checking. This happened.
Yeah, so Shubhri would like.
I had a specific question regarding the FDI chart. So there appeared to be a lot of FDI outflows. So were they foreigners retrenching whatever they had invested, or is it Indian companies investing abroad, auto sector, for example? Do we have any idea of what is happening there? Because either would look at it could turn up negative. So it could be, for example, and usually these are lumpy investments, so you can almost come to know which is the company doing it. Is it because Ford has sort of packed shop and is therefore taking things away for good, or is it that Mahindra is investing abroad in a factory, say Africa, Korea, wherever they are doing it? It's my question, because it looks like a large amount, but it may actually be good if it's an Indian company investing abroad. And not so good, but indifferent, because if Ford has packed up, we know Ford has packed up and is going home and would probably divest its.
Any other questions before? Yeah.
My question is to Dr. Ramesh, and Professor Balakrishnan briefly touched on it. And so my question is, when we see that the states' capex is low, do you think there is a correlation with the high states' debt to GDP, GSDP? Or do you think it has to do more with the borrowing limits that the states have?
So if you look at the annual data on what they have budgeted in this year and the last 3-4 years, we find that overall all states' debt to GSDP ratio has been lower than what has been allowed by the 15th Finance Commission, even during the pandemic, with the 2% additional borrowing that was allowed. In aggregate, states were much lower than what was allowed, though there are a lot of state-wise variation, but then in general, in aggregate, states have been very conservative in terms of spending, in terms of borrowing, and which also answers your question, right, that they have not actually they prefer to remain fiscally prudent, if I were to say, by not availing the borrowing limits which has been allowed by the 15th Finance Commission and Government of India. So, but of course, in the initial, as Ms. Nair had said, that in the early part of the year, there was little problems regarding, or the states were little unsure about the inclusion of budget borrowing in while deciding the borrowing limit. So there was a lot of confusion at the state level, and also the guidelines for this 1 lakh crore or 1 trillion capex loan also came a little late. So while states welcome this, but then there was in the initial first quarter, there was some
Conditions also, no?
not much. 80% is untied through 15 Finance Commission devolution formula. So that largely you see an 80,000 crores going through that. But then in the first quarter there were issues, but then now I think it's picking up, and hopefully we'll see what happens in the next 2 quarters. But it's a welcome step by states. Actually, we talked to several finance secretaries. They were very welcoming this move by the central government, and they expect it to continue for at least for the year or so.
Any other questions before? Yeah.
Just one, again from Manish on this CapEx. Do you see a secular decline in CapEx in states for the last 5 years or so? Because earlier the CapEx expenditure would be around 6 to 7% of GDP in some of the states, larger states. But over the years it has come down. One thing which which I keep wondering about, I haven't got down to the numbers, maybe you will be able to tell me even later, is it because the center has appropriated most of the CapEx expenditures, PMGSY, medical, health, NRHM, medical colleges, now drinking water in a big way over the last 2 years. So these were areas where states would spend a lot of money from their own CapEx budget. What is actually left out is just housing, little bit of housing and irrigation. And large expenditures on irrigation also now is not really much, in the sense a big project type of expenditures are reduced. Just a thought, I mean, I thought I'll just place it before you, but it's a secular decline. That's an observation I have, because when the center announced this 1 lakh capital expenditure scheme, one of the things they said is the reduction in the capex of states, which is making them put this extra money on the table post-COVID.
I also have some points. What we noticed is that at the state-wide level, the priorities of capex are very different, and also the outlays systematically follow a different pattern. So we have some large states, fiscally well-run states, I would say, who have shown a sustained underspending on capex as compared to what they're allowed to do. So it also puzzles us why they don't want to spend more on capex when the space is there. And I would say on average capital spending, if we aggregate all the states, it would not have come down that much as a percentage.
Maharashtra,
As a hardly around half of
highest
the
GDP, GST,
Yeah.
lowest capex
Yeah.
in terms of capex GSTP ratio.
Whereas
So that would pull down your number also dramatically. Manipur may spend 7% of its GST. That hardly counts for anything.
However, let us do the round of the questions.
No,
Give
we can
us-
carry the
yes,
discussion
give us 2
later.
minutes so that everybody
Yeah.
gets to. Yeah,
Ma'am,
yeah.
the questions, one for Sudipto, regarding the solution which we have given in the end, not to tinker with the tariff rates and you can follow the exchange rate depreciation. When the Indian INR is already in a very depreciated mode, like, is there further room to go for that theoretical possibility? And then the second question regarding in general, so regarding the credit growth rate, right? And I think the story regarding the increase in personal and services credit loans increasing, is it indicating something else? Doesn't individuals now reached a state where they're purchasing by taking credit or going for personal loans, we are going to consumption, meeting the consumption expenditure or something else, are they investing or what I have told that millennials are now trying to own their house. Is there one of these things that happen? Thank you.
Do you want to collect questions before we
Yeah,
respond?
I thought. Any other questions? Yeah,
This is with respect to the credit growth increasing to MSME sectors and the increasing formalization of the economy. So basically, larger industries gaining hold and the MSME sector basically falling down. Do you think that will have an impact on the NPAs going forward, given that a lot of capital that these MSME were raising was also to meet their working capital requirements here in the country?
Okay. Two questions. One other thing. Since you've given your summary, do you think the non-tradable services will be the driver of growth in the next 1 year? Is that what you're thinking? And one for Dr. Mandal, between what everybody has said, this is a question that I'm just curious about. That the uncertainty thing, that given the uncertainty, even what Aditi said, that state governments are being fiscally prudent because they're unsure of there is an information dissemination issue, but there's also this uncertainty of how much revenue is going to come in and if how much am I going to spend, then it's not able to plan the expenditure. Maybe large firms, we know that probably that's and on the industrial side, we know that it's affected by uncertainty. So as you go forward, if you were to advise the government, how would you how would you factor that in? With some just.
Can I add one point regarding MSME credit? Is it because there's a definition shift in the MSME definition itself? I think as part of partner record package. So is it because the definition we are including more companies into the sector, and then now that the credits receive more?
Yeah.
Ma'am, my question is to Anand. Yesterday only I was reading in the papers that the RBI must not pause with its rate hikes right now because the cost of doing too little is apparently weighs down on the cost of doing too much right now. Because if the Fed adopting a hawkish stance, if we take a pause right now, how do you think that will impact our economy?
Any more questions? Wait, so would they
First on the
Whoever
There is a
is.
question on it.
Yeah.
So no, actually, we do not have information on that only. So, but we are looking at the basket, right? So we looked at that automobiles industry had that was a outlook. Growth.
Right.
Yeah. So we really don't know what was the direction. So we need to increase.
A report what is called the gross loss, right? So then you will know that whether foreigners are taking out or it's your people who are taking out. So which is that there's this whole there's also an academic paper, Bronner and Didier, which is the gross capital flows. If you see the grosses, then you will know which way it is going. Just stop.
Yeah. Thanks for that.
Yeah. Right.
Okay, on the question of personal loans, we see a very interesting shift in the composition of personal loans. During the COVID time and during 2021, one of the main drivers of personal loans used to be loans against gold jewelry. I mean, that was one of the main driver of personal loans, at least in terms of year-on-year change. We saw 100% growth in loans against gold jewelry. So that was kind of distressed borrowing, maybe for health expenditures and financing and so on. But now, within personal loans, the consumer durable loans have also picked up. So there is a shift towards discretionary spending happening. From earlier, it used to be loans against gold jewelry, credit card outstanding. Now it's towards consumer durable. So that is one point about personal loan composition. About MSME NPAs, see MSMEs overall outstanding, their share in outstanding bank credit is 5%, or it slipped also to less than 5%. So there would not be a very big impact of MSME NPAs on the overall banking sector NPAs. That's one. The other thing is that there have been some reports by on how the ECLGS scheme, the Emergency Credit Line Guarantee Scheme, has fared, and there also we see that most of the loans, those short-term loans, have been repaid. So we don't see a very big spike in NPAs happening due to MSMEs. Also, if we look at the Shishu loans and all these small loans, there also the MSME, the NPA loans is the NPA percentage is quite subdued. So we don't see that as a very big contributor to spike in NPAs in the banking sector. On the definition of MSMEs happening, having an impact on MSME credit, that could be one of the reasons. We don't know the exact composition of MSMEs, how it is defined there. But there are also a lot of other factors, like now MSME registration is happening. There's compulsory registration that has to be done on the Ministry of MSME portal. Then only you will get the priority sector lending. So a lot of these things towards formalization and identification of MSMEs that's happening, which is also leading to increase in the credit. And of course, the credit guarantee scheme has also helped in improving the credit, because the share of formal credit to MSME is still low. That was the main concern, that MSMEs are not in the formal banking sector channel. They mostly borrow from the informal sector. That has slightly changed for the better, particularly after these schemes that have been announced. One point, if on the I got this opportunity. So on the manufacturing sector, if we look at the composition, because NAS does not give the composition which sector has actually seen a contraction in GVA. It's also that other than the input cost pressure, the textile sector has also seen a contraction over the last 3 quarters. So that is one point, and also metals. Metals have seen a moderation, and that is also resulting in a contraction in the metal segment within the manufacturing segment. So these are two.
In metallurgic risk in imports, we have seen that there is a decline in the stocks.
In fact, for the large credit, one of the reasons that the incremental numbers are so low is also because a lot of big corporates chose to do leverage during the pandemic. They cut costs, kill off a lot of other segments possibly, because they cut costs very sharply, like advertising, etc. And they deleveraged, and also seeing that in isolation without the bond market movement maybe is also distorting things a little bit. But net, the addition that you are showing on the MSME side is about 3 trillion. And what you're showing the net addition on the large corporate side is also 2 trillion.
Yes, 2 trillion, but I'm saying that the gap is narrowing as compared to the pre-pandemic period.
Yeah.
That is the only thing, and that is something, an insightful thing, a new way of looking at the credit, other than just looking at the outstanding credit and just looking at the year-on-year change. That is the only thing, what's happened since pre-pandemic.
Also, in a relative sense, I think the 3 trillion, 2 trillion, the base is very different.
Yes.
So, in a relative sense, it's a huge thing for the MSME, which is, as you think, not been noticed before. We've all been talking about this K-shape and, small fellows dying and so on. And probably that's true, but this is a part of the story.
Yeah.
No, I think Manish
Manish has anything?
No, actually, I've not
already
but,
responded.
because I have not looked into these details, but the points which you have raised is quite valid, and some of the points you mentioned are also very valid in terms of making revenue visibility at the stage so that we can actually plan better. So going forward.
But shouldn't it mean that you are delayed by a quarter, but not necessarily by a year?
So at least don't back end all the additional money to Q4.
No, I get that one, but suppose there is poor visibility. First quarter spending can get pushed to second quarter, but not happening at all is not really.
So right now, state capex spending is flat over last year, up to H1.
Okay.
And they have huge amount of fiscal space to be able to spend. Now, the typical story we hear is budgets are presented by the end of March, spending takes off slowly in Q1, then the rains happen. And then 1 quarter no work happens. So actually,
that is true every year.
So
there is nothing.
That's not a news story.
Yeah.
So hopefully in the second half, with so much money on the table, spending can actually pick up. If it doesn't, that means we have a problem, which we need to address. Why, with money on the table, spending is still
Whether the states choose to remain fiscally prudent and not spend is also.
That's what I think what Mr. Jha was saying is making sense. Whether they feel the need to spend. Or what is it they like to spend? And counterposing that is what Professor Balakrishna is saying about, I don't see spending on the ground, so where is the contradiction?
There is another side to it which is not explored much because of some data constraint over the last years, actually numbers coming in. That is the revenue expenditures of states have risen. And that is because they're, apart from the committed expenditure on interest payments, pensions, etc., a lot of state level expenditures are rising on different types of subsidies which are committed. Those type of commitments are not being compromised and scaling down of capex takes place. But this is something on which it is very anecdotal as yet. One has to look at it a bit more deeply. Get a real picture.
So we have
Revenue
data on
expenditure
revenue.
is not really coming down.
We have data on revenue expenditure, I'm not putting, but I don't remember the numbers, but then, as you rightly said,
Have a look at it.
revenue expenditure.
Disaggregate a bit and see how it's playing.
So revenue expenditure was budgeted to move by 18% this year versus 40% of capital move at the state level. But again, the incremental amounts, the revenue expenditure increment is much higher than the capital.
That's
And
what,
that will get spent.
yeah, that we get spent. And there's no compromise or cut.
Okay, so
Final thoughts.
not that final responses to the
Yeah,
there are two, three questions that some relate to earlier things. So let me first on this question of the exchange rate versus tariffs. You see, if our currency account deficit keeps increasing, it will drive. It's not a question of administrative government decision. That's what the market will do. And when that happens, your exports will become relatively cheaper, imports will become relatively more expensive. So the usual way of the market getting closed. Whether that will happen or not is a different question. But coming to interfering with tariffs, you see, they distort relative prices. So if you can achieve the same thing through exchange rate adjustments, then why interfere with tariffs? Once you get into tariffs, it's discretionary. I mean, this used to happen until 91, and since 91, over 20 years, gradually our tariff levels are much higher than the competitors, and it's been gradually has been gradually brought down. Now we started reversing, and this is a very serious backward movement and reform. So that's what I was driving at. And but the additional point I want to make is that you can do what you want with exchange. I mean, exchange can go whichever way, tariffs can be interpreted. But until you establish your really competitive, high productivity domestically, not going to go anywhere. And an illustration of this is that China's space has been getting vacated, right? Other developing countries pick it up. Who picked it up? Not India. It was all Vietnam and Bangladesh. Why? Because they got that domestic act together. We do nothing. We just interfere at the boundary, fiddle with tariff, this, that, and the other. You have to fix your domestic production systems and gain productivity, and then of course the infrastructure story comes. Oh, let me just leave that there. Yeah, then this question, we've already been discussing the point that Bornali was raising. This has been an old point, but I think it's got worse this, and Aditi already made this point that if you don't know what is going to be your outlook going forward, and I'm not talking economic, it's also in terms of how much you're going to get by way of devolution and transfer, revenue to the center. If you don't know the story till half the year is gone, the financial year, and then you have the monsoon kicking, you're really left with something like 3-4 months in which to do all your capital spending. So you're right, states are being prudent, which is why we feel that it's very important for the central government to not just use it as a slogan, but to seriously engage in what is called cooperative federalism. Use institutions like the Niti Aayog or whichever to try and persuade the states, give them some guarantee in advance, as you were saying, you can at least advance the information 3, 4 months from what's happening now. And that could possibly seriously impact on the vehicles. Now, what is happening is you're saying revenue, there's committed expenditure, and then there's what you might call politically committed expenditure. You can't withdraw those subsidies. So where is the axe fall? It's all on capital expenditure, and that's what is happening. So there's a lot of fixing that needs to be done, but one part of it is cleaning up the communications, I think, between the center and the states. One passing remark, Bala, you mentioned about why so much calculus is foreign portfolio investment and all that. Now, magnitude-wise, they're not that large. But if you look at the capital market, it is driven very much, maybe because of sentiments or whatever, but movements of FPI have a direct, very quick effect on stock markets. And that is why you need to take them seriously. Certainly, financial.
And that's the thing, it's true, technically.
And yes.
Destabilize that.
Yeah,
I'm aware of
exactly.
that. I'm aware of that.
So it's the expectations thing which gives it all this importance. One final remark on it is generally, sort of relevant. This is about data. We often take data as it is and try and make sense out of it. But after spending quite some time in moving on villages from both in the north and in the south and so on, I get a feeling that what we are now capturing later on unemployment, you asked me this question, is that's not picking up the story on the ground. Because what I found that there's a lot of circulatory migration. They're all gone away, as you were saying, and they came back, but they don't come away permanently. They will come and work for 6 months in Kerala and go back. They will come for 4 months to Tamil and go back. And so on. Now, where is that being picked up? If you get the data, in NSS, unemployment surveys in the villages, they're not there. There's no work, they're unemployed. But they're not unemployed, they're actually working, on some high-rise construction in Gurgaon and so on. But it's not being picked up there either because, the CMI data and so on depends on when their surveys are designed, when they're doing the interviews. So this circulatory migration temporary is just a data system, just not designed.
And this circulatory migration is quite big in India.
It is very big. This is what I was saying. I'm showing these villages, very backward parts of Jharkhand. You were talking about it. There's no work in the villages. But are they unemployed? No. They are all away earning, and the wage rates are amazingly similar. 300 rupees per day in the village, and that's what they're getting also in construction sites in Gurgaon. But they do overtime, so they make 600 rupees a day, so overtime is double. And they said we can make about 15,000-20,000 rupees a month for about 8 months of the year, and that's a big deal for people at that level of income. But we are just not catching it in our data system. No.
Thank you. Thank you very much for, I would say, a very interesting discussion. And it also, I think for me, it opened up a few alternative ways of looking at things. So thanks a lot. We hope this can be sort of an annual or even a biannual event. So where we can sort of share thoughts on where we think the economy is going, where we think the stress points in the economy are emerging, and I think there is value add in economists who are looking at the medium term, long term, also to look at these and to contribute to this whole conversation, because people like Aditya are anyway tracking it on almost a daily or quarterly basis, and there is wisdom coming out of that, but there is another perspective coming from a medium term view of the world. So we hope for more interactions of this kind. We hope you'll keep joining us off and on.